How's it going? This is Micah here. I'm super, super excited to have everybody on tonight. I know that everybody's been waiting for tonight's presentation. Um, just a little bit of background here. This is Micah, of course, coming to you from Wall Street AO. We've got Mark Sebastian on tonight, and for those of you who don't know, I had the fun opportunity to meet Mark a few weeks back in Las Vegas at the Money Show, where I was meeting some friends and was introduced to him. We had a beer together and kind of started talking about options and trading in general. He started talking about some of the stuff he's doing with volatility. And, you know, I usually consider myself a pretty advanced options trader, and some of the stuff he was talking about was definitely pretty advanced. My eyes started to kind of glaze over a little bit. And my wife, who has a degree in physics and nuclear engineering, was keeping up with him and kind of smiling and nodding. And, you know, me being an options trader was having a hard time. So just to kind of preface that, he's a very smart trader, and I'm really looking forward to getting him in touch with our community and allowing him the opportunity to kind of teach our community some cool things about volatility. And he's got a nice slide deck prepared for us tonight. And I think he's even got an Apple presentation or a trade going on as well. So with that said, Mark, are you there?
I'm here.
Awesome. Well, thank you for coming on, Mark.
Thank you. Thanks a lot for having me. I'm excited to meet your group.
Cool. Well, we have a pretty active community here, and if anybody has any questions throughout today's presentation, you can throw it into the chat room. Mark's going to be doing most of the talking tonight, but at certain times I'm going to be kind of bantering back and forth with him. And yes, it will be recorded, so we will have a replay for everybody.
Indeed. Indeed. So again, we're going to talk about directional trading and how to use volatility to improve directional trading. For starters, let me introduce myself a little bit. That's me. I was a floor trader for about a decade. No, I'm not the redhead. The redhead is somebody else. I'm the other dude. I was a floor trader for about a decade. I was on the American Stock Exchange in New York and the Chicago Board Options Exchange in Chicago. After I left, I started Option Pit. Option Pit is a education consulting firm. We will work with, I should press play. We will work with just about anybody. I have clients that are hedge fund managers, asset managers, money managers, you name it. And I also have regular, standard retail traders. So I like to joke that I've worked with clients with $1,500 and $15 billion. And typically, and the scary thing is, especially when it comes to options, usually if I took a group of people with $1,500 to their name and a group of people with $15 billion to their name, the people with $1,500 their name is going to understand the derivative side better than the other. And it just kind of goes to show you kind of how old money moves around. But in the meantime, I run a volatility arbitrage based hedge fund called Carmen Line Capital. I'm the chief investment officer. We run, nothing crazy right now, but then again, we just started today. Today was our first trade officially as a fund. I'd been trading it for myself for a little while. It's primarily volatility arbitrage. So what are we going to learn today? I'm going to talk about how volatility can be a tailwind or a headwind. All right. We're going to talk about basic buy-sell decisions to profit from directional trading. We're going to discover how strike selection can make the difference between a good trade and a bad trade. I'm going to teach you a couple of combination buy versus sell and strike decisions. And I'm going to give you a little tip on day trading involving VIX. And then, since this is the Apple trading group, I'm going to show you a couple of trade setups I like in Apple, given the current market condition at the end. Specifically for this group, I wasn't planning on doing it, but since we've got the Wall Street IO and an Apple trader, I think it's only fair if I do an Apple trade. All right, so the way I usually present is kind of as a crescendo. So we're going to start out somewhat basic, and then hopefully crescendo out to some stuff that is capturing even some of the advanced traders. So the key to trading options for direction is to understand correlation. Correlation means how one instrument moves with another. All right, a correlation of 1 means that the two will move together perfectly. A correlation of an option can never be greater than 1 or less than -1 relative to its underlying. All right, so no matter what option I pick, it can never correlate more than 1 to its underlying. And that's an important thing to understand. All right, so now correlation can also be called delta sometimes. Delta is, the option trader term for correlation. It can also be called slope in math. And when people ask me, well, why do option traders call it delta? My answer was, it sounds way cooler than correlation. Delta can change for multiple reasons, and this is kind of the key. The delta of an option can change with time passing. It can change with the change in the underlying price. And most importantly, can change with one other important factor, and that's the factor we're going to talk about, which is volatility. All right, so there are a lot of ways to describe it. All right, obviously, we most commonly use that correlation, but it can also be a hedge ratio, all sorts of things. So an option with a positive 0.6 delta makes 60 cents for every dollar the underlying rallies, and it loses 60 cents for every dollar the underlying falls. So what makes it so hard is that it can change on you, all right? And there are some that we can understand easily, all right? And then others that we can't, all right? Others that are not intuitive, and that's volatility. And this is really where people get lost on trading for direction, because they don't get the volatility component. So we're going to delve into that a little bit. So this is kind of how the delta will move with the underlying. If this green line kind of represents how the stock moves, and the blue line is my best drawing of how an option kind of gains with, gains correlation to the underlying. Right, and that's really the key. So now this is my favorite. I get this maybe once a week, and as an ex-market maker, it used to drive me nuts. All right, because listen, there are a lot of things that market makers do to take money from you. There really are. However, most of it is your own fault, and very little of it is this, tinfoil hat conspiracy garbage. So this is a story I get once a week. Market makers are cheaters. I bought all these calls right before earnings. The stock is way higher, but I'm not making any money. Market makers are taking my money. And the real truth is that nobody took your money. The delta of the underlying changed. All right, and that is the key. So let me show you what I mean in Facebook. We got some Facebook traders here, right?
Yeah, I think a lot of people here have either Facebook stock or leaps or calls or.
Why would anyone ever own a stock? Once you figure out how options work, what's the point of owning a stock? That's what I always say. All right, so let's just real briefly look so that we get a real understanding of what I mean. So this is Facebook on November 3rd. And we can just briefly look at the weekly option. And what I want you to pay attention to is the 108 calls. All right, and the 109s and the 110s. I want you to pay attention to that delta. 24, 20, and 16. All right, and then let's go to where they had earnings, and it's trading 108.76 now. And what you notice is the 108 calls barely made any money. The 109s and the 110s lost money. All right, well, what happened? Well, let me just take a quick snapshot here. So you got the stock $6, $7 higher here. And if you'd bought the 108 calls into earnings, you maybe made 10 cents, 20 cents. No, if you bought the 109s, the 110s, 111s, you lost money. All right, and here's a fun part. Take a look at this. The 112s, they're a 10 delta here. Stock's $7 higher, and the 112s are a 9 delta here. So what's going on? It's this number right here that matters. And that is implied volatility. So notice prior to earnings, the 109 calls have a volatility of 77%, 76%. That number is 30 points lower. So the expectation for movement fell markedly. And that's what kills the option. I mean, think about it this way. If, buying options pre-earnings is like buying options the day before a major storm comes through, buying homeowners insurance the day before a hailstorm comes through and everyone knows there's a hailstorm, versus buying insurance the day after there's a serious hailstorm. So this is the key, all right, is that the Greeks, and this includes Delta, are from a pricing model. They are modeled risk. All right. Do we know what modeled risk means versus a pure understanding of risk, or a discrete risk? Model risk is kind of our best guess. All right. So the thing to understand is the Greeks are not an input of the option pricing model. They are an output. Big difference. All right. Input versus output. All right. Inputs into models, garbage in, garbage out. Garbage in, garbage out. And that's the problem with the Greeks, is if you put garbage in, you're going to get garbage out. So if you don't understand volatility and how that's going to affect the Greeks, then you really don't understand the Greeks. So since Delta can change and is modeled risk, picking the right option for the directional opinion is key. Should an option be bought or sold, in the money, at the money, or out of the money? And it all really depends on one thing, and that's the implied volatility. All right, so what makes implied volatility different than trading a stock? Over the long term, we know where the implied volatility of a stock or index is going to go. We don't know where the stock price is going to go. And this is because implied volatility is mean reverting. Think about me. All right, when I was in college, I was a A- student. All right, so if I took a test and I got a D on it, did that mean that I was a D student going forward? No. My next test, I would get a B or an A, and there would be mean reversion. And I'm just kidding. I got straight A's. No, I'm kidding. But really, it's the same in baseball. A player gets really hot hitting the ball for a month. Guess what? They're going to get cold, and their batting average will mean revert. So this is Apple stock. And if you look, you try and tell me there's some average there. There isn't. It can go as high as it wants. It can go as low as it wants. All right. If you look at this 200-day moving average. This gray line is the 200-day moving average here. It just kind of slowly creeps higher. Although it's in a death cross right now. Who here is a big believer in death crosses? Yeah, no. I think anything called death cross sounds really interesting on CNBC and is borderline worthless as a trader. So, you know, there's no real mean here. They both move around. Now, do you guys know what VXAPL is? Do you guys ever talk about VXAPL, Micah?
You know, occasionally we talk about it. It's basically volatility for the volatility index for Apple, right?
Yeah, it's the Apple VIX.
Right.
And so I thought we could take a look at this. Is VXAPL. And this is a very simple gauge of where volatility is in Apple. And this is a 2-year chart. And I want you to look at that 200 and even the 50-day moving average. And that thing is flat as a frickin' pancake. Over the lifetime, if you look at Apple volatility, you know, in the last 2 years, right around 29-ish, we'll say, that's been kind of right in the middle of where Apple vol is. All right, especially around non-earnings, when vol gets way bid, it reverts back, and when it's gotten too cheap, it's been a purchase. Options have been a huge purchase. So I love these like Apple VIX, and there's actually the SIBO actually disseminates about 50 of these indexes. There's one for, so there's 5 equities. There's VXIBM, VXGS, VXGOG, which is Google, VXAZN, which is Amazon, and VXAPL. But they also have the GVZ, which is gold. They have TY VIX, which is the 10-year treasury. RVX is the Russell. I mean, there are legitimately 50 to 60 of these indexes. And the nice thing is not everybody has my fancy trading software. And so if you want to analyze volatility, those indexes are really out there for you to use. And they're pretty good.
And you can buy and sell options on the VXAPL, correct?
You cannot. There's talk of them listing, but they do not have them.
Okay.
Where can we get a list of those as they exist? You know, if you go to the SIBO's website and you go for
So you're using the VXAPL more as a gauge rather than an actual trading vehicle. Gotcha.
Well, I mean, right, as a gauge of where implied volatility is. So I'm not using it as, I'm using it as kind of my buy-sell decision. When do I want to buy Apple? When do I want to buy options? When do I want to sell options? And that's really what it's for. So you can see they've got all these different volatilities on indexes. They've got all these different indexes. You name it.
Cool.
And they're awesome. They really are effective. And I look at them all the time. But I use it's at the CBOE website. So the question is, where do I get a list of those? And if you go to the CBO website, they're there. You just might have to do a digging or two. I don't want to spend 5 minutes looking for it in the middle of a webinar. But although I get that question every time, so you would think I'd be smart enough to have that fired up by now. But what's the definition of crazy is doing the same thing expecting a different result. So the key is with volatility is that it can go anywhere. A stock price, Apple was $10 when I was a floor trader in 2004. All right, and then it's now split adjusted 800. It can go anywhere and stay there and keep going. Volatility can go anywhere, but it can't stay there. And that's the key, and especially in indexes or in equities. All right, over time it must mean revert. And that's the key to understanding buying and selling. So in general, when implied volatility is low in the option, all right, in the equity, we want to buy. All right, and I'm going to show you over and over again why. So and especially in the long term, all right, when IV is low, it makes sense to buy. When it's high or even normal, all right, it makes more sense to sell. All right. The one thing to remember is the mean volatility is actually high. So anything the mean of implied volatility and higher is a sale, and really even kind of below the long-term mean. And then anything that's kind of in that lower quartile is a buy. So there are two main ways of getting long. We can sell puts or buy calls. I'm not going to get into spreads yet. All right. And each trade acts very differently despite having kind of a long exposure to the underlying. So short puts are long delta and short vega, which means they're short exposure to implied volatility. You know, delta is the exposure to movement in the underlying. Vega is exposure to movement in volatility. Thus, the trader is hoping the stock moves higher and implied volatility comes in. So what makes implied volatility drop? And the answer is implied volatility drops usually because movement drops or the perception of movement is dropping. All right. So a short put is a play on lower movement. All right. When you sell a put, you're not betting that the underlying is going to go higher. You're betting it's not going to drop. Do we all understand mentally what that means? Anybody here a hockey fan? I'm counting on option traders also liking hockey. What do you think? All right. Well, you know, back in the old days before they had overtime, or when they had overtime, but before they had the 3-on-3, if both teams tied, they got a point. And so the teams would play not to lose so that both teams got a point. And that's really what selling a put is. Selling a put is playing not to lose. All right? You're betting the underlying is not going to drop. You're not betting it's going to rally. Two very different mindsets. Think of it as playing not to lose. All right? So here's JP Morgan. And you can see volatility nice and high up in here. Stock's getting kind of slamaged. And so you say to yourself, do I want to buy calls here? Or can I sell like the 55 put? In this case, the 55 put was the play because implied volatility drops and the underlying moves higher, but not crazily higher.
Right.
And that's the key. Let's see what we got here. When the stock drops, puts are very expensive. Valiant Pharmaceuticals, yes, although I would not suggest selling puts in Valiant because that is a black swan, $30 in your face trade waiting to happen. Although I've done some trades in Valiant that have worked out well. I would never go naked a put when in a name like that. I would always step in with some sort of protection. And I'm actually going to show you kind of what I might do in a name. So Apple's down $4. What do? I'm going to show you at the end.
Yeah, and I would just second that, everybody. Just be really careful. I would not also short naked puts on VRX. That is just a death trap. So
yeah,
do be careful with that.
Generally speaking, if the implied volatility is over 30, and that's one to think about twice. If the implied volatility is more than 4x the normal vol, don't sell puts. All right, that is when that's where you know what recency bias is, guys. It's the belief that what has happened recently means that it must apply to the long term. And retail traders get caught in recency biases all the time, like selling puts when a stock goes down and volatility explodes, until that thing shoves it up in your face. We had some Google strangle sellers that thought there's no way to lose on Google, and only to see it move, 2x the straddle price. Yeah. So, and actually the Valiant guy, there was a Valiant put strangle seller that was short at, I'm going to go off on a tiny little tangent here, but we've got time, right?
Yeah, we've got time.
All right. Well, and I love showing idiots get their lunch handed to them. Here you go. So we had the guy step in, I want to say right around here. Nope. Where is he? Nope, that's not it. I want to find this guy. This guy sold I think it's going to be here. So this is a guy that thought, well, Valiant's been off 10% today, and the vol is 72% in normal volatility. He's looking at a chart here. Pull this aside. Oops, sorry. He's looking at a chart of Valiant. He's looking at a 2-year chart. And he's looking at kind of this October time frame. And he's going, wow, Valiant's in the, vol's in the 70s. This time last year it was 25. This premium's a sale. So he steps in and he sells on a ratio the November 145-190 strangle, collecting $14. How do you think that worked out for him? Well, I will take you to where he takes it off. I mean, he just gets his sack handed to him. Like, I remember we were, I do a radio show, and we were like screaming the show about this guy to cover, and of course he didn't. And it starts moving in his face really quickly.
Yeah, that sounds like a pretty ugly trade there.
It was awful. And you can see here he's starting to unwind pieces of this. So here it is, 118, and I don't think he's fully unwound his trade yet. So you sold a $14 strangle, and your short strike was the 145. So you're short at basically below 131. You're delta 1. So he's already down. He's already down 25 handles, 20,000 times. That's a cool $5 million. My guess is he got fired. So that's why you don't sell naked puts in Valiant. So now let's talk about long calls. All right, a long call is a long delta, so it's long that exposure, but it's also long that exposure to volatility. So you're actually hoping the underlying goes up and vol goes up. And what makes that happen? An increase in movement and an increase in expected movement. So when you buy calls, you are thinking this is going higher. Very different. This is ULTA. This is one of my favorite ones. My wife is a fashion blogger, so I've got like the inside scoop on all the retailers. And I was like, "What do you think of ULTA?" She's like, I like it. They've got good makeup, blah blah blah. And I'm looking at it, and it's trading around 155 after kind of getting slapped around. And this is in the middle of, kind of that October time frame where things were still a little hairy. And so this is October 15th. This volatility gets to a serious, serious low and we look and we just buy the 170 calls. And then over the next couple of weeks, we buy the November 170s. The stock just goes straight up, and the vol goes straight up. This was in our strategy letter. And that was a really nice trade.
And Mark, those options, did you kind of try and plan those out to maybe buy a couple weeks after you knew earnings so that you made sure to participate in the earnings vol as well in that?
You know, well, the earnings were, yeah, I mean, one of the things I do like in terms of earnings, I love trading around earnings. What you'll find, I'm not somebody that usually takes positions into earnings, but I love owning earnings months and earnings contracts ahead of earnings,
Right.
and then
Right.
dumping out of them before we take the risk. You know, there's, and again, a little sidetrack here. So I'm in the middle of, there's a couple of studies by Goldman Sachs that basically say earnings is a total crapshoot from a probability standpoint. And then my friend Russell Rhodes is working on a similar study with options that only carry weeklies, and he's seeing the same thing. So the only way to win earnings is being right over time, is to be right on the direction that you pick. Believe it or not, selling strangles and buying strangles both lose over time, and they lose to the amount of what is the bid-ask spread. Is this the same as implied volatility? I thought IV stock price decline as stock price increase. You know, that's the whole point, Steve. So Steve's saying, you know, I thought volatility falls when a stock price is rallying. That's just it. When we see kind of a stock kind of moving around a little bit and they're just killing the volatility, what that means is that, you know, do you know what you guys call overwriting? Which is when people sell upside calls to basically produce income for a long position. So when I see a stock that's been kind of rallying just absolutely see its implied volatility get murdered, you will see that's a great time to buy upside calls, because the overwriters kind of they kind of get overboard with themselves and they sell too much premium. So then what happens is the stock starts to rally, and I'm long ULTA, and I'm short I buy ULTA for 150, 160, and I sell the 170 call. And then the stock starts ripping higher, and I realize that I want to be long ULTA. What am I going to have to do to those options that I just sold as an overwrite? No. So if I overwrote, so I'm already short them. So if I'm short, I'm going to have to buy them back. So what happens when an overly sold stock has low volatility because overwriters shorted them, and then really overwriters bought the stock because they think it's going up. The stock starts to go up. They all race to buy them back, and the implied volatility pops. And you know who's there to sell it to those overwriters when the vol pops? Yes, us. Exactly. You guys are picking this up. I love it. All right, so now getting short. Like going long, you know, like going long, the same basic buy-sell decisions apply. So when IV is high and one thinks the stock is going to go down, don't sell calls, sell call spreads. Just from a margin standpoint, it's far more efficient. And when IV is low and one thinks the stock's going to fall, and I'm going to talk about this a little bit, buy puts. Absolutely. So this is IBM. IBM has been the garbage stock of the year. All right. And every time it's dropped, it's kept dropping. So when you get these kind of pops in near-term volatility, this chart's a little older because I'm going to show you some low vol to buy. All right. When you get some near-term pops in volatility, you sell call spreads. You sell the 62-67 call spread. You sell the 65-70 call spread. And the vol drops and the underlying falls or sits. and you just bank the premium. All right, so now let's talk about buying puts, and this one is more recent. And IBM, terrible earnings, awful earnings in July, gets pounded, and for some odd reason, they just crushed the implied volatility. This red line is implied volatility. Absolutely crushed it. Quite possibly the easiest put purchase in history. When you got a crappy stock with volatility in the toilet, you buy puts. You will be happy. All right, so the kind of the basics of buying and selling. You know, just to sum it up, when vol is medium or high, sell it unless it's crazy high like Valiant. And when vol is low or, you know, or dirt cheap, buy it. Buy options. There's nothing wrong with buying options. All right, so now let's talk about strike selection. All right, so now that you know whether you want to buy or sell, the next step is strike selection. And this is done based on the certainty of the next implied volatility move. So when one believes that implied volatility is going to go up, you buy softer deltas. I'm going to explain what that is. And when one believes that implied volatility is going to be stable or go down, you trade hard deltas. And again, we'll walk through those. So what's a hard delta? A hard delta is relatively resistant to change in volatility. All right, and that's going to be an in the money or an at the money option. All right, and the more in the money, the harder the delta, the less it's going to move with volatility. All right, soft deltas are deltas that are very dependent on changes in volatility. They are out of the money and far out of the money options. So understanding the difference will make a big difference in strike selection. So this is an older example, but it's just so good that you know that they're great to walk through. So when would you want to buy hard deltas? All right, so that's when one isn't sure of the future IV movement, when IV is very high, when you're not sure of the severity of the expected move, but you want to have limited risk. So here's Goldman. All right, and notice the stock's low. Obviously, it's a lot higher now. And the vol is high. But I'm saying, okay, I think the stock's going up. So my options would be 1, sell a put, or 2, buy an in-the-money call. So the stock's trading right around, in here it's trading right around 116. This is this time last year. So the Goldman December 22 calls, all right, are trading about $7.60, or I can do the 125 calls that are 96 cents. All right, well, a week later, Goldman is higher. And my 110 calls are $10.60, and my 125 calls are $1.19. So let's do some math on this. On 11/15, Goldman's trading $15.44. And if I buy one December 10 call, I pay $760 for 70 deltas. Or I can buy 8 Goldman Sachs December 125 calls for 96 cents. I spend $8 more, but the model tells me I'm getting 130 deltas. So for every dollar, theoretically, my Goldman Sachs position should gain $1.30. Well, let's look at what goes on a week later. Goldman's up $5. I sell my 110 calls at 10.65 for a profit of $3.05. That's $305 for a one lot call, almost 50%. I'm never going to fault you for that trade. That's a good trade. Meanwhile, my 8 Goldman Sachs 125 calls are worth $1.19. So I make $184 on my 8 calls. So think about this. I spent more, I bought more options, and bought more exposure, and made about 60% of the dollars. The volatility component beat me. That is why I did not make money. All right, so now let's talk about a soft delta. Soft deltas are more sensitive to changes in IV. And there's some very specific times where they can make a lot of sense. So IV is low, really low. All right, when vol is low and you're expecting a major move. And then, sometimes when you want to make an inexpensive bet and implied volatility is low. So here's IBM. And this was before last year's tank job. And what do you notice? The implied volatility, low. The stock, right around 190. So here we are on November 21st versus November 23rd. So on November 21st, I could have bought the 185 calls for 680, or I buy the 195 calls for 122. 2 days later, notice the difference. The 185 calls are $9.30. The December 195s are $2.25. So if we think about it, we paid $680 for 75 deltas, or we spent $610, so we actually spent less money on this trade, and we bought 145 deltas. Well, we bought about double the exposure, and in this case, check out the profit. I sell my one call at 9:30, I make $250. Again, never going to get mad at you for making $250. All right, unless it involves poor risk control. I famously told students that if they worked for me, I would have fired them for their risk management habits. So on December 5th, so on the 11/23, my 195 calls are worth $2.25. I make a $5.15 profit. About $1 a spread, and so I make $515 on my 5 calls. So I'm more, I make almost 100%, and I make more than double what I made on my 185 call, and I spent less. Huge outperformer. And that's where I have no problem buying out of the money options. You just need to know what you're doing. All right, so now let's talk about, so now we've kind of talked about buying, selling, and then I've talked about strike selection. So I'm going to show you a couple of trades that I do. All right, so I follow all those VIX methodologies that the CBOE disseminates. And this is a trade I do like clockwork. So a stock hits a 52-week high, and that VIX index hits a 52-week low. I buy the first call that's out of the money. Super, super simple. And this is an older one, Goldman, but I did this trade. And this is VXGS, VIX of Goldman Sachs. And you can see it gets, the one thing I know is that when Goldman Sachs implied volatility gets below 18, it should be bought every time. either as a straddle or as a call. Almost never a put. So what's going on? Well, what happens is they announce earnings, stock drops a little bit, they kill the vol. Stock starts to climb and they keep volatility low. Well, look what happens. You're riding this volatility higher and the stock is skyrocketing. Easy, simple dollars for directional trading. So this is one from Tesla. So if you look back here, in April, Tesla has earnings, right? See here? Stock vol plummets. And look what they do here. They absolutely crush the implied volatility. Well, guess what? Buy and buy. That stock's going straight up. All right, so it's a very simple approach to trading these things, but it's effective. So now, what about over here? Take a look. So they're killing implied volatility again after earnings, but instead the stock has been dropping. So what does that tell me? Well, let me talk about trade number 2. And this one is actually more effective than call buying. So when in the implied volatility or a VIX methodology hits a 52-week low, at the same time a stock is hitting a 52-week low, buy the second put that is out of the money. Sinking IVs and sinking stocks almost always mean the stock is going to go lower. Why? Why do you think? What causes implied volatility to rally when a stock drops? What causes implied volatility to rally when a stock drops? There are really 2 reasons, but I'm really concentrating on one. Well, no, that selling of the stock is not really the cause. So I saw unexpected move, fear. Fear is much closer. Buying puts. Why are people buying puts? What are they doing? So somebody said buying puts. Well, expecting down. There's the right answer, Dan. Dan said hedging. They're buying protection. That's right. So if a stock is tanking and nobody's buying protection, what does that tell you? No. Someone said going to rally. The low IV, yes, the IV is low. But what are they doing? Instead of buying protection, what are they doing? No, wrong. What are they doing instead of buying protection? What was that?
It's Mikey here again. I was just commenting that maybe they're just selling their stock.
That's exactly right, Micah. They're just dumping their stock. They don't care. You buy puts in things you might think rebound. Yeah, they're just dumping their position. So take a look at gold. I'm sure we've got some gold bugs floating around, but take a look. Gold's rough all year. And I was saying gold's going lower, gold's going lower. Well, why? Take a look at gold vol all year long. Now, I think gold's finally bottoming, kind of finding where its bottom is around here. Because look at what happened when it finally got down to this level. Look at what happens. So gold drops for all the way through to June as people are just dumping options. Now, it actually goes to the 52-week low and people are buying stuff. Yeah, people finally figured out that finally found a level they want to own gold for. So they're buying puts and buying stock. They're hedging. So GVZ is the VIX of gold. So that's one that people can follow if they're not used to stuff. But yeah, there was just some wonderful opportunities to go long gold vol into this whole mess. All right, so now I'm going to just briefly talk about an intraday trade that I do, and then I'll show you what I think about with Apple. So the ES and SPY. Anybody here S&P 500, SPY, or you know, something like that type of trader? Intraday as a day trader. All right. Well, if you're going to trade ES, you better start watching the VIX futures. All right. Why? Well, it's because VXX and the VIX futures almost always lead big moves in the S&P 500, like clockwork. And I'm going to tell you what to look for, especially on a down move. So you've got SPY kind of sitting in a range. Meanwhile, take a look at VXX. What's going on? S&P sitting in range. Meanwhile, they're bidding up volatility. And then what happens? The market falls apart. It is incredible the way VIX futures will tick, you know, a good 15, 20 seconds ahead of this is VXX, which is the tradable 30-day VIX iPath short-term ETN. VXX and almost always leads SPY, and the VIX futures almost always lead S&P. And you guys want to know why? This is my theory. Because vol traders are smarter. No, just kidding. No, you know, I think it has to do with that. Volatility because it is just can be more fluid, and there's a lot less noise in the VIX futures right now, because you can't do like electronic program arbitrage like you can with the S&P versus the basket index. So because VIX really does trade on an island, it tends to move first. So the key is, even though SPY is flatlining, VXX is slowly rallying. And when you see that on an intraday basis, that is almost always a sign that the market is about to sell off. It can also point toward an intraday high and is one of the strongest indicators for a market turnaround. And actually the other way around is even better. When you see volatility falling as the market is falling, that's a great sign that the market might turn around. So in summary, volatility reverts. Implied volatility helps form positions. There are different types of delta for different positions, and understand hard versus soft, and that VIX and VXX leads. I'll show you my offer. What is the delta range? And I'm going to show you my offer. I'm going to show you my Apple trade, and I'm going to answer questions. So a little offer. Whoops, wrong link. This was supposed to be changed by my assistant. I promise you she will be fired post haste. Kidding. One knee. So it's optionpit.com/option-income. And what you're going to get is what I think is a really good follow-up to this course. It is a 45-minute course. It is a 45-minute course that covers debit and credit spreads. So I'm going to teach you about buying and selling debits and credit spreads, strike selection in debit and credit spreads in depth. I'm going to teach you how to actually execute better, so that on average, my goal by the time you're done, you should have a good idea on how to pull an extra nickel out of every spread. And I'm going to teach you some risk management techniques that I use. We'll sell it for $197 or $147 on the site. And through Monday, it's just 12 bucks. Go to optionpit.com/option income. And there's no automatic reoccurring billing associated with this. It's 12 bucks. And the idea is that I hope you take it and you say, boy, that guy, I like him. I want more. So it's what we call a loss leader. So here's a question. What is the range? Sure. What is the range for soft versus hard delta? So I'm going to say a soft delta is going to be anything that has a delta less than 40. And a hard delta is going to be anything with a delta more than 60. And at the money kind of is its own thing. It leans hard, but it is in and of itself very volatility sensitive. So the delta is less likely to change on you, but it is very volatility sensitive. So I tend to put that into the hard delta space, but it can really, but your profit and loss can be affected by movement. So, you know, the key is an at the money option. If you buy an at the money option and you're right, you probably won't lose money. And that's really what delineates a soft delta from a hard delta. A hard delta, if you buy it and it moves in the direction you're expecting, you should make money. It is entirely possible to buy a soft delta, be right on the direction, and lose money. All right, any other questions?
Hey, Mark, it's Micah here.
Hey. All right, well, why don't I show?
Awesome, man. I really appreciate you coming on tonight. And I'm actually probably the first one here to buy your course. I just bought it here for 12 bucks myself. I learned a few things myself. Again, I consider myself a pretty advanced options trader. However, it's always great to hear from and learn from people who actually traded on the floor. The kind of experience that us traders who kind of trade from home and learn from home just don't quite ever get to fully understand or get access to, so I appreciate you coming on.
Yeah, so
One of the things that I really got from you today is the soft delta, hard delta. It makes a lot of sense. Loving your descriptions about volatility and some of the ideas regarding when the stock's hitting a new 52-week low, VIX is hitting a new 52-week low. You know, the reason that why the VIX isn't higher is because nobody's buying options to protect themselves. They're just dumping their shares. So I really like those trade setups. I think they're very actionable, and I appreciate you posting those up.
Cool.
Again, I just grabbed this $12 offer from you myself, and I'm looking forward to going through it. I've got a monthly budget for my personal education, even though I feel like I'm a pretty darn good trader. But I think that it's important as anybody who's wanting to continue to trade to have an education budget for them to continue their higher education. And so I would definitely recommend everybody also jump on this. For 12 bucks, I mean, it's pretty much the cost of a trade for a commission. So super thankful for you coming on. If there's any other questions, I'm guessing Mark will probably hang around for another few minutes.
Yeah.
You still there, Mark?
Yeah, I'm going to hang around. Well, I promised everybody an Apple trade. Now I wanted to show everybody what I'm looking at. So this is just something small. This is like my little paper account. So most of my trading is in VIX. So if I pull up VIX, you'll see some larger positions that I do. But in Apple, I do like to put on things just to watch. And so the trade I really like, I think Apple's going to turn around, but I do think it's set for potentially, especially with kind of people disappointed with the iMac or the new iPad Pro, to kind of soften for a little bit. So the trade I like to do is called a 1x3x2. Let me show you what it looks like. And so what I'll do is I'll buy one kind of near the money option. I'll sell 3 the next one out and buy 2 underneath. Now I put this trade on for a nickel credit. I like getting paid to do this trade. And if you look at the P&L profile of this trade, it's what we call a slow burner. So I'll just show you a one lot trade. So this is kind of what the one lot looks like. If I just show you my own positions, this is kind of what my trade looks like now. And the idea is if I do it for a credit, so I'll show you when I can do it for a credit now, because things moved around a little bit from this morning when I was playing with this. So clear sims. So I can buy, you know, one of the, I'm gonna have to play with this a little bit, but you know, if I think the underlying is gonna drop, I could buy like 1 by 3 by 2, do a trade like this, potentially collect 2 cents on the spread, and then if Apple eases lower back toward that 105 strike, I'm in a position to do really well. And you know, I'll sometimes do these if I can get them on for a good credit or as a longer term trade. Imagine I did this in January. I'm definitely going to get a credit there. You know, imagine I do the 100, 105, or 95, and then I guess in this case I'll do the spread like that. Getting a nice credit, so I'm getting about $1.20. So then what I can do is I'll take, if I really think Apple's going to turn around, I'll take some of that credit and I'll just go out and buy like a cheapie out of the money call spread. I could buy like the one, you know, I could buy like 2 of the 125, 135 call spreads and have a net credit on the whole thing. So I'm using this belief that we might ease lower to actually get a net finance on my long position. Why deceptions? I just like it's just about duration. You know what? I did that trade. Do I have an example of a Netflix trade? I did a very similar trade in Netflix. I do a lot of those types of trades. Do the Apple trade. So that's what I was kind of looking at. Now, if you're saying, Mark, I think we're going to turn around now, well, take a look at Apple volatility, and you guys tell me, is it a buy or a sell? What do you think? Probably a buy, right? If I was going to do anything, probably a call. I'd be looking to go long call spreads if I was bullish, or like some sort of short butterfly. Yeah. All right. And it was, and the vol was way higher earlier in the day. It was kind of screaming when Apple was down. You know, Apple was down more than $1 this morning at one point. So, all right. Any other questions? All right.
That looks pretty good, Mark. Thanks again, buddy.
Hey, thank you. Have a great evening, everybody.
Definitely, and you're going to have the replay up on your site. I'll make sure all my people get a link to it so that everybody can take notes again and kind of go through your study here.
Awesome. All right. And actually, I'll have the replay posted on that same landing page. I have to obviously post it, but what you'll do is you're just going to click right here. Click the replay.
I see. Too easy.
There. All right. Cool beans, everybody.
Awesome, Mark. Thanks again, buddy.
Bye.
You bet. See ya. Take care, everybody.